Hello. It's a rainy day. After a week of rain, the sun was shining earlier today, and there is a brilliant red tint to the leaves this year as we prepare for the Thanksgiving Day weekend. Welcome to the huddle for today, October 8th, 2020. My name is Bob Simpson, and I am your host for this series of webinars. Today's focus is on performance of financial markets for the third quarter of this year, and to address the changes that have been made to the portfolios and how that has worked out. Joining me today is Paul Tyers, Managing Director of Wealth Stewards and Portfolio Manager. Welcome, Paul, to the call today.
Thank you.
Now, we record each of these sessions, and if you go to portfoliostewards.ca, you see the circle on the screen there. You can go down, click there, and you can register for these, as most of you have already done, or you can view the recordings of these sessions. Also on the control panel, there is a Q&A button. So as we did a couple weeks ago, what I'd like you to do is click on the Q&A button and just type something in like, hey Bob, what's the weather like in Mississauga today? In today's huddle, we're going to focus on an investment review for Q3 2020. Please note that this is a review of our portfolios and performance for a specific period of time, and that none of the information contained within is a recommendation of any of the securities discussed. Please consult your wealth stewards or advisor at a firm of your choice before implementing trades in your portfolio. Performance of your personal portfolio may differ from the numbers stated in this presentation, as there are many factors that affect the performance of individual portfolios. Now, 2020 has been a tumultuous year for investors, but no more tumultuous than the effect that COVID-19 has had on the lives of people around the world. As I was preparing this presentation, I heard a speech from Joe Biden in which he made a statement that COVID-19 has had a very positive impact on many of the rich and a devastating effect on the poor. The same can be seen if we look at financial markets and stocks like Apple, Microsoft, and Amazon, where we've seen their market values soar. In fact, Apple's market value has soared from $1 trillion, which is a big number already, to $2.3 trillion. Microsoft's market value has jumped from 1.15 trillion to 1.75 trillion, and Amazon's value has jumped from just under 1 trillion to 1.6 trillion, whereas many companies are experiencing major losses and are simply holding on to survival by the tips of their fingers. Now, let me begin by looking at the major financial indices, starting with the S&P 500 benchmark. Recovery from the late March lows continue to be strong for Q3, and the S&P 500 produced a total return, including dividends, of 8.93%, which was reduced somewhat by a strong Canadian dollar, bringing the return to Canadian investors down to a respectable 6.83%. On a year-to-date basis, losses of almost 34% for the index have been totally recovered, and at the end of September, the S&P 500 is up 8.75% or 5.57% in Canadian dollars. In Canada, the TSX has had strong performance, turning in a 4.73% return in Q3, but that's still underwater by 3.09% year to date. So although we've seen really strong performance, the TSX has really not even recovered back to where it was before. Now, indices can be deceiving. So I just want to spend what I call an educational moment here. Although indices are a great way to track overall market trends, they don't always tell an accurate story. Indices like the S&P 500 are cap weighted, meaning that the bigger companies make up a higher percentage of the index. In fact, the 25 biggest companies make up 41% of the index. So out of 500 companies, 25 make up 41% of the index. The top 10 companies make up 28% of the index, and two stocks, Apple and Microsoft alone, make up 12% of the S&P 500. So in this chart, you can see how the rich are getting richer and the poor are getting poorer. If you only owned Apple and Microsoft and you failed every single diversification rule, your portfolio would have returned over 44% during a tumultuous year for stocks. If you own the 10 biggest companies, you would have returned over 33%. But if you own the S&P 500, that return was 6.5%. So the performance of indices like the S&P 500 have been largely skewed by a very few companies. So when we look at that, it's not like every company is performing well, just a few there. Now, if we look at the average performance, digging deeper, we can look at the S&P. And if we looked at the average performance of the 500 companies, we see quite a different story. Year to date, the average company on the S&P 500 lost 3.5%, including the big guys that we talked about. They had a pretty good third quarter, though. Now, as a result, for investors, balanced portfolios where your portfolio manager can't simply make a big bet on 2 or 3 stocks like Apple or Microsoft, but must diversify to protect you from when a combination of Apple and Microsoft fell by almost 30% in March. Returns are buffered on the downside. A diversified portfolio doesn't do as bad when markets go down, but they can't match the performance of 2 or 3 stocks on the upside. Now, this is not an excuse, just what I call an educational moment. The TSX Composite Index is another very different story. If you look at the chart on the right, you can see a breakdown by sector of the TSX. Notice, first of all, financial services. That sector is made mostly of Canada's biggest banks like Royal Bank, TD Bank, Bank of Montreal. The sector makes up 32% of the index. Next, look at energy. Energy makes up 12%. But there again, that's really a bit deceiving. Large energy companies this year, like Imperial Oil, have seen their stock price drop. Imperial Oil, beginning of the year, $35, currently trading at $16. Suncor, beginning of the year, trading at $45, currently $16. And what we see when we look at a lot of portfolios that come in from other advisors, they're really very Canadian centric, and they have high percentages of energy and that sort of thing. Beginning of the year, energy was 20% of the index, but because it's performed so poorly, it's down to closer to 10. So again, something that you need to look at. So we tend to steer away in our strategies from energy and metals and mining companies because they don't pass our earnings growth, our consistent and predictable earnings growth test. Now, also look at the chart on the right, and you'll see that Shopify actually makes up 8.15% of the TSX. Shopify is now Canada's biggest company, bigger than Royal Bank and TD Bank. And it's had a big moves over the last little while. So if you look there, look at how Shopify's price has really skyrocketed and makes the other indices look like they haven't even moved. But on the chart on the right, you see that Shopify's earnings, they don't have any. They're still losing money. But you're looking at a stock that has just absolutely soared and now makes up 8% of the index. How did the average TSX company perform? Not exaggerated, as exaggerated the S&P, but you'll see that the TSX Composite is down 5% year to date, but it performed fairly well in Q3. Another thing you have to keep in mind is that portfolio performance is difficult to measure against indices because most people don't have all their money allocated to stocks, but actually hold a combination of stocks and bonds. So you can see chart on the left, is 40% equities. Chart on the right is 50% equities. So 50-50. So you really can't compare performance to the indices. Now, the other thing that affects that is that interest rates are at a historically low level, near zero, and bond investors generally make money when interest rates fall. So there is really little chance when 10-year Canada 10-year bond yields are 0.55% that you're going to make money in bonds this year. So we at Wealth Stewards have turned our attention, like many of the major pension plans like Canada Pension Plan, to private debt or alternative investments. And Paul will discuss that shortly. So I'm going to turn things over to Paul. If you're ready, Paul, or I can take this one
I
and
am,
go
Bob.
to the next one. Okay.
Thank you for that lead in. In March and April, as many of us were coming to grips with the impact of the pandemic, we began in a very intensive process to assess and reconstruct our portfolios, first to mitigate risk and then to take advantage of opportunities presented by the pandemic. We shifted our equity focus from a value approach tilted towards small cap companies, largely because previously we were in the tail end of a growth market that was long in the tooth, let's say. But we shifted then to specific sectors that we felt would thrive throughout the COVID pandemic. It also allowed us to target companies, Amazon being a good example of people comes to mind, that would clearly benefit from the pandemic as more and more people got comfortable buying online, and we avoided companies in sectors like energy that we thought would struggle during the pandemic. So this was a fairly dramatic shift, and one of the things we felt is after the major decline, we also wanted to focus on large companies, strong fortress-like balance sheets, because traditionally you'll find that those are the companies that do well in the early stages of a recovery. But the reality is, even before recovery, we were looking at this through the lens of what we don't know, what could happen in the event of a large, of a protracted lockdown and so on. This has really led us to earlier on with bond yields where they were. We're very, very thankful that we had already made a move away from bonds into some of the private debt area. And that really protected us from downturn in portfolios to the extent of certainly an equity-only portfolio. Now, I just want to, this slide graphically displays really our strategy from a U.S. standpoint. These are the types of names that you'll recognize, the likes of Walt Disney, Alphabet being Google, Amazon, Home Depot, Hershey, and so on. And quite frankly, we're quite happy with the way that these have performed during the time that we've had it. Now, you can see that the breakdown by sector. So we wanted to focus, as I alluded to earlier, on sectors that we thought would do well during this time period. We picked companies that really over the long run had shown very strong growth. So you can see here the 10-year numbers of across that entire group of stocks, the average growth on a per annum basis was a little over 21%. And then we were also looking at companies that had earnings per share that we expected to increase dramatically. Well, I guess we weren't looking for dramatically. We were looking for ones that would increase. And lo and behold, when we actually started looking at the analyst numbers, some of them were quite anticipating fairly dramatic increases in the earnings per share. Now, not all of that has come to pass as yet, but that was part of the initial strategy. And then the other thing is we were looking to come in at a reasonable price. So we wanted to come in at price earnings ratios that were at the time less than the average, than the 5-year average. And we were able to get those fairly handily. Now, some of these have actually come back nicely. And so you will see here that some of the current PE ratios across the board at the top, 56.6% or times versus a 5-year mean of 48.51. That is has grown a whole lot since we've owned these particular stocks. So there are a couple that we're watching fairly carefully. One of those examples would be Cisco. As you can see on the list, the stock price has come up a whole lot, but since it's really outrun its earnings, we have actually made a decision. We're exiting that security, having had a nice bounce back already. And that was the example. I should have gone ahead to that slide. Now, let's look at things from a Canadian holdings point of view. And again, once again, here you're going to recognize some of these names. We have added a couple just in the last week. Not all of these, by the way, have been implemented in every portfolio. We have to look for cash availability, and then we actually have to look for a place, just the right suited spot for some of these securities. So, for example, Dollarama has not yet been implemented, nor has Finning International. That was a recent selection we made, in part because the protracted, the view that COVID-19 is going to continue on longer than we thought. Now, from an earnings perspective here again, you can see that we're looking for fairly strong increases in the earnings per share from what we were expected at the time. And if that comes back, if it happens, unfolds as we expected, that is the key driver of stock prices over the long term. So that's what we're really hoping comes to pass, even with the uncertain times that we have. You can see here that Canadian National Railways, as an example, from a PE perspective, has become quite expensive as compared to its 5-year mean. So that is one that is on the watch list. We like Canadian National Railways over time, but it's become expensive. And we're sort of looking at, is the earnings per share likely to come to pass? So I should have used this as going through. And again, same thing. We've actually got good, strong numbers on 10-year numbers on these. So let's shift gears a little bit as how have we done? And we want to go through and judge performance. And you can see the U.S. strategy has performed well from an individual standpoint. Although it beat the S&P 500 before fees, this does not account for the negative effect of holding defensive cash positions. So we had selected some of those stocks, but we also wanted to pick the right entry point. So it's not as that we actually had more cash at times throughout this period of time by being defensive. So we give this strategy B+. The Canadian strategy has lagged the performance of the TSX Composite as we over allocated to two stocks. We were looking for stable returns, and we obviously did not go into a Shopify as it did not meet our selection criteria. But obviously, as it turned out, that helped push the TSX higher. Overall, with the Canadian market being largely dominated by oil and gas, metal companies, as well as financials, and we were avoiding the oil and gas market, we have taken a much stronger, we made a much stronger allocation to the U.S. strategy than the Canadian. We're not making excuses overall, but we would rank our performance in the Canadian side as probably a C. And just of late, I want to comment that the two banks that we moved into, TD and Royal Bank, have performed quite nicely. In fact, they outgrew their allocation. And with the extension of COVID, we actually, in the last day or two, we have actually lightened up on those strategies, those particular securities. Real estate. In the real estate section of the portfolio, this is a sector that was absolutely brutalized with public REITs. And you can see that in the chart on the left. And really not a lot has come back. We're happy in the selection that we did make with the real estate that we chose. We've actually outperformed the index there. And in the middle is where we use, outside of the Canadian market, internationally, we're using a fund, and that has done well again against the index. But probably most important of all is an overall move to things like Equiton, which is a private company REIT. And in the long run, we see this as a sector because it's really an investment in where people are living. We believe that that's a stronger area at the time, and we will see less volatility as we move forward. So overall, the public real estate sector has performed very poorly, but we are not ready to pull the plug on that. We would score a D on that because the sector, our investments within the sector have consistently outperformed the benchmark. So we would give ourselves a C from that perspective. When we look at the global managers, and here we're using some funds to achieve this. We're very happy with the selections that we shifted towards. You can see an 8.48% return in this time period versus a 6.83% benchmark. Okay. And in this area, we would give this strategy a strong a B+. Last but certainly not least is the fixed income area. And Bob, we alluded to earlier, historically low returns, interest rates, the proxy for that being 10-year bond yields down around 0.5%. And overall, we're very pleased that we started the strategy, not during COVID, but starting about 5 years ago, started moving away from traditional fixed income into alternatives that could give us a more predictable and steady return. We had no idea at the time how low interest rates would actually get as a result of COVID. The average return on an annualized basis of our fixed income, private debt, has been 5.8%, which is really more or less what we had expected. And that's what we're trying to get to, is more predictable returns. So we're quite happy with the move over time that has moved away from traditional fixed income. Looking at things overall, although the equity markets have recovered strongly, driven by large cap companies like Apple, Microsoft, Shopify, our balanced portfolios are much more diversified, are still slightly underwater for 2020, which is more in line with more balanced, equal weighted indices that Bob alluded to earlier. COVID-19 has had a dramatic effect on public and private businesses. There's no minimizing that. And the financial markets, not to mention people and families around the world. Although we had a period when the rate of growth on new cases declined for a short period, it seems evident, certainly in Canada and Ontario in particular, that rates have once again spiked higher as businesses and schools have reopened. And in fact, leadership of the world's leading economy, as we know, has been downplaying the devastating effects of the virus, and they're feeling the effects of that with the number of cases. We've chosen to take a much more defensive approach. because we believe that capital preservation is our first priority. So we have had more cash during this time period than we would traditionally have. But we did in late March, early April, identify some of these bargains. And we do think that should there be a second leg down in the financial markets, we'll be in a position to actually capitalize on some of those. As you can see here in Q3, our moderate conservative portfolio had a 2.07% move forward, balance 2.17, moderate growth 2.85. That compares to the TSX of 5.54. Clearly, that's strictly equities, and the S&P equal weighted index strictly equities is 6.75. On a year-to-date basis, we can see that the industry indices on an equal weighted basis are still both underwater, and our returns remain underwater on a year-to-date basis, but fairly modestly. To conclude, we made significant changes to the portfolio during the second quarter to reduce risk and better position the portfolios to take advantage of opportunities. At this stage, we continue to manage the portfolios defensively, and will continue to do so until uncertainties related to COVID-19 and the US election give us a little bit more clarity. I want to thank you for taking the time for joining us today. Keep up to date. We want to invite you to become a regular viewer of the Huddle webinars that take place every few weeks at 3 p.m. every Thursday. For more information, please visit www.portfoliostewards.ca, or you can always reach out to your Wealth Stewards advisor.
Yeah. So our next session, and one of the things for this session, Paul and I invited Trump and Biden just to see how a presentation like this can be done without arguing the whole time. Our next session is slated, again, just to fill you in on our approach to this. We're doing the huddles every second week. We're alternating between financial planning oriented sessions and investment sessions. So two per month, one of each there. Our topic for the October 22nd meeting is the metrics of wealth planning. Understand how to quantify how financial and estate planning impacts your net worth. But now we are on to everyone's favorite portion of the call, and that is the Q&A. So the one question is, so Bob, this session's gone on for about half an hour. What's the weather in Mississauga like right now? And actually it stopped raining and the sun is out. So that's where we are on that. If you have any questions, click the Q&A button there and we will be pleased to address. No, I had something on chat there. Yeah. So open to your questions. Now, Paul, just to sort of get the ball rolling. So a lot of changes this year, right? It was really, I think you touched on it, that earlier in the year we were, going into this year, we had really a small cap bias. And as somebody said to me, you were small cap value and looking at, you had a lot of ETFs and things. So, trying to keep the cost down. Now, what effect has there been on fees by using individual securities as opposed to the ETFs?
Well, that's a good question, Bob. One of our mantras is to always watch the costs in portfolio management, and watch any tax slippage. I can tell you that the costs are somewhat higher when we're both from a transactional standpoint and potentially a tax standpoint, when you're going into individual securities and you're trading in and out of them. By no means do we plan to turn into a high turnover, high trading organization, because we don't think that that ultimately yields results. Having said that, we don't want the tax and cost tail to wag the dog at a time where the more fundamental issues are security of capital and capitalizing on opportunities. So there's no question that there will be somewhat of a higher cost to that, but you can see in the recovery in the portfolio has more than made up for or offset any increase in trading costs, and probably any tax liability that's created from some of the rise and then moving out of those securities.
Right, but by holding individual securities, we are not paying another manager a fee to hold those securities. So the fees over time should be quite a bit lower than if you hold ETFs. Is that?
That's an excellent point. Yes, I didn't mention that, but clearly in the short run, you've got a trading cost. In the long run, what you remove is the ETF costs. Now, we had made a point of trying to find, very reasonably priced ETF fees, but even at 30, 45 basis points, over the long run, it is, we remove that cost effectively.
Right, and we've shifted some of that to hiring some specialist managers to allow us to go into global markets and to some specific sectors that we feel are of interest. So we've saved money on one hand, we've spent a little bit in fees in another area. Overall net result should be, fairly decent drop in overall fees. Now we have another question, which is, does your defensive stance on COVID depend on a vaccine being approved, or is it based on some other metric? Paul, do you want to take that, or do you want me to take that?
Yeah, I wanted to digest it for a moment. I think it's fair to say that we are not focused on trying to time trying to either time when a vaccine comes out or who comes out with the vaccine. There's certainly been plenty of chatter on the internet about whether it's Moderna or Gilead or some other entity that's going to come out with it. We just think that that's speculation. It's not investing. So the other metrics that we're looking at are, we believe, more predictable metrics, and that is the earnings numbers, where they are today, where we expect them to be. The entry point, are we able to purchase it at a reasonable price compared to historical? And maybe the most important part, given this, is really being practical about which sectors are likely to do well given the impact of COVID. So as an example, when we clearly have fewer cars on the road, or did, and we're really not back to where it was, clearly demand for oil and gasoline has gone down a whole lot. So there's just a very practical issue of not wanting to hold energy securities until there's a lot more certainty. Candidly, we think because those prices had very little to do with what was going on in Canada traditionally, we haven't been very keen on them for a while. But a long answer to a short question, the metrics that we try to go to are metrics that are more predictable as we look at the markets.
Mm-hmm. Okay, another question that we have here, Paul, is as a client, if I'm attracted to a particular stock and it's not in my portfolio, can I request that you guys purchase it in my portfolio?
The answer is yes. And in fact, when some clients have transferred their funds to us, they actually have designated and saying, we want to keep these. Sometimes it's for a pregnant capital gain purpose. Other times it's security that they really like. And in other cases, it's somebody who has a particular security in mind. Now, one of the things that we will do, because we think it's in our client's best interest, if somebody has an idea on a security and they want to put that in their portfolio, if we have some concerns about that, we are going to raise it with the client because we think that that's the right thing to do from a client's interest. However, at the end of the day, it is a client's portfolio. If they insist that for the reasons that they have, they want to move ahead, absolutely, we will go ahead and put that into the portfolio.
Right. So, Paul, Judy says that you've been fading in and out on the audio, so maybe stay close to the microphone. Do you want to just say a couple words so we hear if that's better? So I think that's those are the questions that we have today. We try to keep these things reasonably tight. This is being recorded, and if you want to go over it again because you have some specific questions, or you wish to address the investment management committee directly, contact your advisor, and we're happy to spend some time with you. Now, just to address the last question, is that we use some fairly sophisticated. There's some software that I introduced to Wealth Stewards, which is which really helps us to analyze companies, to pull up the numbers. Do we see consistent and predictable earnings growth? Is it expected to continue? Can we buy them at a reasonable price? If you have securities elsewhere and you would like to have that portfolio analyzed, just contact your advisor at Wealth Stewards, and we will be glad to run an analysis of those holdings. Or if you have a simple idea, like a stock that you want to buy, we can pull off lots of information to help you to decide if that's a good idea or not. Anyway, that is, unless Paul, you have any other thoughts for today, I think we'll call it a day now that the sun is shining again, and we'll wish all of you a happy Thanksgiving weekend, and hopefully COVID is not going to hinder your family activities.
I just wanted to join us. Yes, have a great Thanksgiving weekend.
Mm-hmm. Okay, awesome. So thanks for joining us, and we hope to catch many of you in a couple weeks.